Welcome to this explainer. Picture this. You finally do the responsible thing. You start saving money. Every month, you move a little bit into your savings account. $100 here, $200 there. You feel good about it. You feel responsible, disciplined, and financially mature. My name is Jack, and if you're someone who has money sitting in savings but isn't quite sure how to start investing it, make sure to hit the subscribe button and give this explainer a thumbs up. Because today, we're going to break down the exact step-by-step path to turn saving into investing without feeling overwhelmed or risking your financial security.
But here is where the frustration usually begins. One day, you open your banking app and realize something strange. Your savings account has $10,000 just sitting there, and it's earning something like 0.5% interest. This means after an entire year of ironclad discipline, your grand reward is a measly $50. Try not to spend it all in one place, right? Meanwhile, you keep hearing people talk about investing, stocks, index funds, compound growth, and suddenly you start wondering, wait, am I doing this wrong?
Part 1, the savings illusion, protection versus growth. Part 2, math versus psychology. Let's start with something that might sound a little controversial. Saving money alone will almost never make you wealthy. Look, saving is important, but it's not the final goal. It's just the first stage. Because here's the thing. Savings protect your money, while investments grow your money. And those are two very different jobs. Let's look at the math for a second. Imagine you save $10,000 in a typical savings account earning 1% interest. After 1 year, you have $10,100. Not bad. But let's compare that with investing. Historically, the S&P 500 stock market has returned about 10% per year on average over long periods. If that same $10,000 earned 10% annually, after 1 year you'd have $11,000. Now, that difference might not seem huge at first, but here's what most people don't realize. The real magic is compounding over time. After 20 years, savings at 1% equals about $12,200. But investing at 10%, that equals about $67,000. Same starting money, completely different outcome. And this is where it gets really interesting. The true financial divide in our society isn't usually between people who save and people who spend. The biggest wealth gap is actually between people who save and people who invest. Disciplined savers put in the hard work of accumulating capital, for sure, but without taking that next step, they miss out on the heavy lifting that compounding growth does for the consistent investor. So if the math is that clear, what's the problem? Most people never make that transition. And the reason isn't math, it's psychology. Saving feels safe. Investing feels risky. When your money sits in a savings account, you can see it. It's stable. It doesn't just drop 5% on a random Tuesday afternoon. But investments? They move. Sometimes up, sometimes down. And that emotional volatility really scares people away because they rightfully don't want to lose the savings they worked so hard to build.
Part 3, the step-by-step path to safely transitioning.
Now, you might be thinking, okay, Jack, but I don't want to lose my savings. Totally fair. And that's exactly why the transition from saving to investing should happen in stages, not all at once. You do not have to put your financial security at risk. Here is the explicit 4-step framework we are going to use to make this transition safe and manageable. Step 1, build an emergency fund. Step 2, separate your money mentally. Step 3, start small. And Step 4, focus on simple investments. Let's dive into each one. Step 1 is absolutely non-negotiable. Before you invest a single dollar, you should have 3 to 6 months of living expenses saved in cash. This is a real emergency fund, and it stays entirely in your savings account. It's not for investing, and it's not for exciting opportunities. It's for unexpected problems, like a job loss, medical emergencies, or car repairs. Because here's what most people don't realize. The biggest reason people panic sell their investments is because they need the money too soon. An emergency fund protects your investments from your own life. Step 2 is a massive psychological trick. You need to separate saving from investing mentally. Think of your finances as 2 distinct buckets. Bucket 1 is your safety money. This is your emergency fund, and it literally does not move. Bucket 2 is your growth money. Because your safety money is locked down, you can give your growth money permission to fluctuate. Its only job is to grow over time. This simple mental separation reduces your anxiety dramatically when the market moves. Step 3. Start investing small. Look, a lot of beginners are held back by the myth that you need thousands of dollars to start investing. You don't. 50 to 100 bucks is all it takes to get going on many brokerage platforms. The goal at this stage isn't massive profits. The goal is building the habit, because habits matter so much more than timing.
Step 4, focus on simple investments first. Here's where beginners often make a critical mistake. They jump straight into high-stress, complicated strategies. Day trading, crypto speculation, options trading. Keep it incredibly simple. Avoid those traps and focus on index funds. These funds track the overall stock market. Instead of stressing out trying to pick one winning company, you're investing in hundreds of companies at once. It provides diversification, lower risk, and steady, long-term growth. It's simple and it works.
And hey, you don't just have to take my word for it. Legendary investor Warren Buffett has repeatedly recommended this exact approach, noting that low-cost index funds are best for most investors. It validates a profound truth in finance. The simplest, most boring investments almost always outperform the complicated, exciting ones over the long haul. Part 4. The secret of consistency. Once you have set up these simple investments, you face the final boss of wealth building: time and unyielding consistency. Now, here's what most people don't realize. The most powerful investing strategy isn't some secret algorithm. It is the sheer compounding power of consistency. Let's look at a quick example. Imagine you invest just $300 per month into the stock market. If the market averages an 8% return per year, after 25 years, you'd have roughly $285,000. But here is the crazy part. You only contributed $90,000 out of your own pocket. The rest, almost $195,000, comes purely from investment growth. That is compounding working in your favor. But remember, psychology still matters here, because investing feels a bit uncomfortable at first. Let me give you a beautiful metaphor to keep in mind. Saving money is like storing seeds in a jar. You are perfectly protecting them, sure, but absolutely nothing grows. Investing is like taking those seeds and planting them in the dirt. At first, it just looks messy. You don't see results immediately. But over time, things grow, and eventually you have something far bigger than those original seeds.
Part 5. Surviving market crashes. Even with a great metaphor, you might be thinking, well, what if I start investing in the market crashes? Let's address that anxiety head-on. Crashes are completely normal historical occurrences, and believe it or not, long-term investors actually benefit from them. Because you are investing a set amount every month, when markets drop, your monthly contribution automatically buys more shares on sale. This often leads to much stronger returns when the markets inevitably recover. This is exactly why experienced investors stay calm during volatility. They are rewarding themselves by thinking in decades, not days.
To summarize the ultimate lesson of this explainer, we are combining two very powerful forces. Saving money gives you defensive stability. It ensures you can sleep at night and weather life's storms. But investing gives you offensive freedom. It buys back your time and grows your wealth. The earlier you combine both of these forces, the more incredibly powerful your financial future becomes. So, as we wrap up this roadmap to wealth, I want to leave you with a question to evaluate your own financial standing. Are you currently stuck in the saving stage, protecting your seeds in a jar? Or have you already started planting them by investing? Take a moment to think about your next step and start putting this framework into action. Thanks for joining me on this explainer, and keep learning.